Warren Buffett is known for his investing prowess. He's also known for his patience. Recently, he's made headlines by selling off billions in stocks, including a big chunk of his Apple holdings. Why? Because Buffett is sitting on a record $277 billion in cash at Berkshire Hathaway. That's a lot of dry powder. This move has everyone on Wall Street talking. What does it mean for the market? What does Buffett know that we don't? Buffett isn't just holding cash, he's accumulating it at an astonishing rate. In 2023 and 2024 alone, Berkshire Hathaway's cash pile has grown significantly. This growth is hard to ignore. It's a clear sign that Buffett is seeing a change in the market landscape. Is he preparing for a downturn? Or is he simply seeing better opportunities on the horizon? Some analysts believe Buffett's cash hoard is a sign of caution. They point to the fact that he has increased his cash position before previous market downturns. For example, before the dot-com bubble burst in the early 2000s, Buffett famously held a large cash reserve. He did the same thing before the 2008 financial crisis. This strategy allowed him to buy stocks at bargain prices when the market crashed. However, others argue that Buffett is simply being opportunistic. They say he's not necessarily predicting a crash. Instead, he's waiting for the right moment to deploy his capital. Buffett has always been a value investor. He looks for undervalued companies with strong fundamentals. He's willing to wait patiently for the right opportunity to buy. To understand Buffett's current strategy, it's helpful to look at his past actions. Before the 2008 financial crisis, Buffett began selling off assets and increasing his cash position. This move seemed counterintuitive at the time, as the market was still booming, but Buffett saw the warning signs of an overheated market. He knew a correction was coming. Similarly, in the late 1990s, Buffett avoided the tech stock frenzy. While other investors were pouring money into dot-com companies, Buffett stayed on the sidelines. He didn't understand the tech sector well enough, and he wasn't willing to invest in companies with sky-high valuations. His discipline paid off. When the bubble burst, Buffett was sitting on a mountain of cash. He was able to buy great companies at bargain prices. Section 4. The Oracle's Approach: Value over Timing. Buffett's investment philosophy is not about timing the market, it's about finding value. He's not trying to predict when the market will go up or down. He's looking for companies that are trading below their intrinsic value. He believes that over the long term, the market will recognize the true worth of these companies. Price is what you pay. Value is what you get. This approach requires patience and discipline. It's not easy to sit on a pile of cash while everyone else is making money in the market, but Buffett has the conviction to stick to his strategy. He knows that over time, his patience will be rewarded. Section 5. The Buffett Indicator, a market reality check. One way to gauge market valuation is to look at the Buffett Indicator. This indicator compares the total market capitalization of U.S. stocks to the country's gross domestic product, or GDP. Buffett himself has called this indicator probably the best single measure of where valuations stand at any given moment. Currently, the Buffett indicator is flashing red. This suggests that the stock market is overvalued. This doesn't mean a crash is imminent, but it does mean that investors should be cautious. Buffett's large cash position could be seen as a reflection of this cautious sentiment. He's waiting for valuations to come down before he makes any big bets. Section 6. Patience is a virtue. Lessons from Graham and Buffett. Buffett's patient approach to investing is rooted in the teachings of his mentor, Benjamin Graham. Graham is considered the father of value investing. He taught that investors should focus on a company's underlying business, not its stock price. Graham also stressed the importance of having a margin of safety. This means buying stocks at a significant discount to their intrinsic value. This provides a cushion against potential losses. Buffett has taken these lessons to heart. His recent moves suggest that he's sticking to his value investing principles. He's waiting for the right opportunity to deploy his capital, and he's not afraid to be patient.